fracture report from Bank of America, one of the biggest financial institutions on the planet. And that credibility is exactly why this is making such big waves. They're basically arguing that the game has completely changed, that a fundamental structural revaluation of silver isn't just coming, it's already happening. Okay, so the bank builds its entire case on three core pillars. Let's dig into the first one, which is all about a historic financial indicator that they believe is stretched to its absolute breaking points. They call it the ratio collapse. To really get what they're saying, you first have to understand the gold to silver ratio. It's actually one of the oldest metrics in finance. It's simple, really. How many ounces of silver does it take to buy one single ounce of gold? It's a classic way to measure their value against each other. And according to this report, this is the number that unlocks everything. So right now, we're sitting at around 59 to 1. The report uses this great analogy for this. They call it a coiled spring. Just picture that. It's been stretched way, way out from its historical average, and it's just wound up tight, ready to snap back. And listen, this isn't just some abstract theory. We've seen this exact thing play out before. Just think back to 2011, amid all that global economic uncertainty. That ratio crunched all the way down to just 32 to 1. And why? Because silver's price absolutely took off way faster than gold's did. But wait, it gets even more dramatic. If you go all the way back to the high inflation mania of 1980, the ratio collapsed to an unbelievable 14 to 1. The report actually calls this the black swan scenario, something that's super rare, but it has happened, and it could happen again. So this is where it gets really mind-bending. Let's just run the numbers based on where gold is today. If that ratio just snaps back to where it was in 2011, boom, you're looking at $135 an ounce silver. But what if we get a repeat of that 1980 chaos? Well, that is exactly how they get their bombshell number, $309 per ounce. All right, so that's the historical argument. Now let's move on to pillar 2, which is all about what's happening right now. They call it the wall of money, and it's about a massive amount of cash that's just sitting on the sidelines. So get this, the report points out that right now, the big money players, we're talking high net worth investors, huge institutional funds, they have a tiny, tiny fraction of their assets in precious metals. We're talking half of 1%. From the bank's perspective, these guys are dangerously underinvested. And this is where you really see the disconnect. The bank's own models are practically screaming that for the kind of economy we're in, that allocation should be somewhere between 20 and 30%. So the gap between where the smart money is and where the bank says it should be, well, it's just enormous. And that gap? That's what the report calls the wall of money. Their point is simple. If even a tiny fraction of those trillions of dollars decides to move into the silver market, which is physically pretty small, it would be like trying to fit a tidal wave into a bathtub. The market just couldn't handle it, and prices would have no choice but to skyrocket. Okay, on to the final piece of the puzzle. Pillar 3 moves us from the world of finance to cold, hard reality. It's not just about money anymore, it's about the physical metal itself. And the big problem is, we are simply not digging enough of it out of the ground. The report makes a really stark point here. By the year 2026, we will be looking at the 5th year in a row of a major structural silver deficit. And let's be clear, this isn't some short-term blip. It's a persistent supply problem that's actually been getting worse for years. I mean, just think about all the tech that needs silver. Solar panels, electric vehicles, all of our electronics. Industrial demand is soaring. And it's consistently, year after year, outpacing what miners can physically pull from the earth. The math is simple. We are using way more silver than we produce. And, don't expect this to get fixed anytime soon. The report basically says the easy silver is all gone. All the stuff that was simple to get to has already been mined. So now mining costs are going up, the quality of the ore is going down. It's just getting harder and more expensive to produce every single ounce. And there's no quick fix for this. You can't just flip a switch and get more silver. As the report lays out, bringing a new mine online is a massive undertaking. From the moment of discovery to the first day of production, you're often looking at a timeline of more than a decade, sometimes 15 years. So, what happens? What happens when you take a historical ratio that's stretched to its breaking point, add a giant wall of money just waiting on the sidelines, and you mix in a physical supply crisis that's getting deeper by the day? Well, the report has a pretty dramatic name for it, the Great Convergence. And this right here, this is the absolute heart of their entire argument. It's not any one of these things in isolation. It's the fact that you have this perfect storm brewing, a historical indicator ready to snap, trillions of underallocated dollars looking for a home, and a physical supply that just keeps shrinking. All of these powerful forces are converging at the exact same time.
So what's the bottom line? Well, the report doesn't mince words at all. Its final conclusion is incredibly blunt. They state, and I quote, "The era of cheap silver has ended, and the era of structural revaluation has officially begun." They're not just forecasting a temporary spike. They are declaring a permanent fundamental shift in the entire market.
Which really leaves us with one final big question to think about. If this math really is as inevitable as the report claims, is the market totally focused on the wrong thing? The report